from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
This is Bloomberg Technology. I'm Caroline Hyde in New York, in for Emily Chang. Coming up in the next hour, it's no longer full steam ahead for Silicon Valley. Consumer sentiment is changing quickly. Tech sector trying to keep up. We'll look at how Amazon and Apple really managed to win over these obstacles. Plus, the Chinese government tried to create a stealth TikTok account to promote propaganda in the US. Closer look at how Chinese state influence could be reaching younger generations. And the FTC is signaling caution to big tech mergers. Chair Lina Khan overruled her staff to sue Meta over its acquisition of a VR company, which wasn't necessarily an expensive deal to begin with. We'll discuss the aggressive tone this case is setting. We'll get to all of that in but a moment. But first, what a day on the markets, what a week, what a month. Stocks staging a comeback. Best month since 2020. Pleased to say Taylor Riggs breaks it down for us.
Hey, Caroline. Once again, here we are together. But as you mentioned, the S&P 500 having one of the best months since about November 2020. Technology, though, is where it was at. The best month since about March of 2020. So big gains here for the month of a NASDAQ 100. Apple, Amazon actually posting one of the best months since, I think, 2009. So really big tech and these trillion-dollar companies back here on top. Tesla, we just threw that in there because it wouldn't be fun if we didn't at least mention Tesla once a day. That stock up 30% for the month. Change up the board, though, and we'll sort of see how we're thinking long term with some of the technical levels as well. Because we'll talk about energy. We'll maybe get to that later. But as you know, Caroline, a lot of this was some of the big technical levels that we had seen, really trying to recoup some of the big losses as well. Let me finish and just go cross-asset for you, if we will. We talked earlier, big tech being really boosted by yields that are declining 44 basis points on the month, the biggest monthly decline in yields since March of 2020. So that's really where you had technology get a lift. As you know, I do Bitcoin just for you. But China tech not participating in this rally.
Taylor, thank you. Putting in the extra hours there. We really appreciate it. Now, let's look at Amazon. Taylor highlighted it, proving its e-commerce power and cloud computing businesses also helping churn out revenue that even consumers, the worry there about inflation, couldn't offset. It gave revenue forecast of as much as 17% growth in the current period. Really relieved investors, and we saw it in the share price reaction. 2009, best month since 2009. Spencer Soper, you've been covering it, particularly the consumer angle. And Spencer, from the perspective, what's amazing is before the earnings, we were really worried about what Walmart was suggesting, what Best Buy was suggesting, and then whoomph, just Amazon shows its power and prowess.
Yeah, there were, and relief, the word you just used earlier is exactly right. There was these kind of expectations, caked in, and then, the results kind of blew those concerns away. So investors were very relieved that both Amazon can resume growth, like you say, up to 17% in the current quarter, and also keep a lid on spending. They shed about 100,000 workers and started getting that spending in control, whereas previous quarter they had a lot of concerns about overbuilding and having too many people. So, and investors were worried how long that was going to last and drag on. This quarter showed they're kind of, starting to unwind that and starting to see some more positive signs.
And with the positive sides, of course, the forecast was what relieved. Any more details? You sat there on the call yesterday. Andy Jassy or his team spell out how they managed the next quarter.
Yeah, one big thing, especially on the spending, was investors are always worried about how quickly is Amazon going to spend whatever comes in, and because of that overbuild on their delivery network, they're going to cool off on warehouses and delivery stations, those sorts of things. But they are going to spend more, and it's going to be more targeted on data centers and fueling its cloud computing business. So they really gave a signal that they're going to double down on the cloud computing, and they're expecting that to remain strong, even as they kind of cool off investing on the e-commerce side.
And what's so good or in this particular environment about Amazon vis-a-vis, say, the Walmarts, the Best Buys that have such inventory loads that they now need to basically cut the price of, is Amazon does have a very different sort of business model behind it. How has that helped it weather?
Yeah, that's a great point, and something that really shone in this earnings report. Amazon has this marketplace model where 57% of the products sold in the second quarter, that's the highest that number has ever been before, come from these independent third-party merchants. And the main thing that means is when stores like Walmart, Target have this inventory risk and have to take deep discounts on products they've already purchased before they resell them, Amazon doesn't have that inventory risk. If a merchant has to, take the price down on something to sell it, even if that merchant takes a loss, Amazon is not exposed. Amazon still gets a commission. Amazon still gets paid to pack and deliver that product. So a lot of this marketplace model kind of shields it from this inventory risk that some of the other retailers are facing.
We really want to thank you, as always, for bringing us the expertise when it comes to Amazon. Spencer Soper, thumbs up. Happy weekend. Meanwhile, let's talk about the recent changes, the navigation that these companies are having to do around consumer behavior, around sentiment, because Jason Borstein's with us, principal at Forerunner Ventures. Of course, a lot of your portfolio very much around the consumer. You, of course, are Bonobos, a company that's all about consumer engagement and sentiment. And I'm interested, Jason, there was a particular note coming from Wells Fargo that caught everyone's eye. I know it caught yours too, saying basically if we're in a recession, no one's told the consumer. Do you think that the consumer is resilient in this current environment?
Thanks for having me. It's a pleasure to be on the program. Absolutely. We at Forerunner, really believe in the resiliency of people. We hold people at the center of everything we do, and we're optimistic about the future. We saw consumers be incredibly resilient and adaptable during the pandemic, and we believe that will hold up, through this economic backdrop and in the long run as we think about the next decade ahead.
Why?
You see consumers spend levels are high. The sentiment, on the other hand, is low. They're really taking in what's happening right now, and they're adapting, and they're taking precautionary steps. So we're hearing about, 39% of consumers are, are creating a budget. 26% of consumers are creating a savings account for an emergency fund. They're beginning to make changes, certainly for lower income consumers. We saw this with Walmart coming out this week and lowering their profit target when consumers are shifting dollars from discretionary categories like apparel to categories that are more necessities like food. So consumers adapt. That's their resiliency, right? They may face tough times economically, personally, or at a macro level, but they adapt. Yeah. And that's where we see the resiliency coming in.
Jason, also many have talked, there are different types of consumers out there. There are the consumers that at the moment are facing, a balancing act they cannot win. Groceries cost more, gas costs more. They are going to have to curtail their purchases. But then there's the more luxury end purchaser who is able, despite perhaps their 401k falling off a cliff and despite some of their stock prices having been damaged, are still willing, with the pent-up demand, to be traveling, and therefore your portfolio company Away comes into my mind's eye, or still willing to be buying an Apple iPhone or an Oura Ring, which perhaps costs a little bit more. Are you thinking that this consumer is bifurcated?
Absolutely. I think that that's true right now. I mean, I hope we certainly have our eye towards opportunities that have the lower income consumer in mind, and increasing access, increasing costs for them. But I do think that we are experiencing that. I mean, the reality is that this is a complex and dynamic time for consumers. As we mentioned before, spend is remaining high, sentiment is low. On the one hand, consumers want to get out there and live their lives coming out of the pandemic. They want to eat out. They want to travel. On the other hand, they have inflation staring them in the face, and their dollars aren't going as far as they used to.
Yeah, I've heard much view that actually this summer they'll do it. This summer they're like, I am just caution to the wind. I'm getting on that flight. It costs me a lot. But people are already buying. For example, Walmart said, look, we think that the shopping period for the September return to school is actually really good. But my worry is I'm the parent. I'm looking at Amazon Prime Day and buying my kids their lunch boxes because I don't want them to get more expensive. Are people buying, stocking up now, and then perhaps into the winter and in the fall, that's when we start to pull back?
I think that there's a possibility of that. At this moment, we're seeing a shift in spend from durable goods, these one-time replacement purchases that people made during the pandemic, and they're not putting dollars towards that anymore. They're thinking about things like back to school, like travel, some of the services that they didn't get to spend on in the last couple of years. With that in mind, very much so, though, do believe and see that consumers are taking precautionary steps, and they will start to pull back. For the middle income and upper income, we haven't seen that effect yet. For the lower income, we have seen that. And to your point, in the back half of this year, that's something that we have our eye on for sure.
And we're looking at your portfolio at the moment, and Chime is one that comes to mind. And of course, you were talking about how the consumer is wanting to save. You're seeing a change in the way in which they're wanting to have savings for emergency rainy day funds. What about just a desire to be in the market, a retail investor, one that wants to be seeing and building wealth? How are you thinking about that from a fintech perspective as well?
There was a lot of energy around that, of course, over the last couple of years. I think the reality has set in. There's plenty of individuals that got burned, that were chasing what I see as a free lunch, and there just isn't a free lunch. And so the realities are setting in. I'm hopeful that consumers will want to continue to participate as retail investors. I think that is important. Increasing access to new categories of investments. This is critical for broad wealth creation. That being said, chasing the trends, people are feeling the pain of that right now. And I think that will probably color and shape how they invest going forward.
Jason, it is always fascinating to have someone who's so early in one success story like Bonomos and then gone on to be in VC and thinking about these sorts of consumer-facing companies. We thank you for Runner Ventures principal Jason Borstein there. Really great, thoughtful answers. Meanwhile, coming up, chips race between U.S. China. It is heating up, and it's not the only point of tension between these two countries. More on that next. This is Bloomberg. Now, of course, this week we had the big news. The House and the Senate have passed the CHIPS Act. The bill goes to President Biden's desk next to get signed into law. Now, meanwhile, U.S. itself is tightening restrictions on China's access to chip-making gear, according to two major equipment suppliers, which further underscores basically Washington's accelerating efforts to, win out versus Beijing's economic ambitions. Let's bring in Bloomberg's executive editor for Asia Technology, who happens to be in the U.S., Peter Elstrom. Thank you so much for being with us. And we have seen already, there were reports that America was leaning on European equipment makers to stop selling over to Beijing and to China, and now leaning on U.S. manufacturers. Talk to us about the latest news we know.
That's right. Yeah, we had two CEOs of chip equipment makers who came out this week and talked about new restrictions, tighter restrictions on their ability to export gear into China. And this is part of course, the ongoing tensions between the U.S. and China. The Biden administration has been following on these plans to try to restrict China's ability to get the equipment that they need to be able to make the most advanced chips. So what these two CEOs have talked about is that now they're widening the scope of that. In the past, the hurdle was sort of 10 nanometers, which is really the most advanced chips, and now they're expanding it to 14 nanometers. And so the chip makers are now pulling back, and they're disclosing to their investors that they have these tighter restrictions. And this is part of this broader clash that the U.S. and China are going through right now, where the U.S. is trying to hold back China as it tries to build on its chip-making expertise in particular, but more broadly, the ability to build its technology sector.
China's response, from your perspective, Peter?
Well, they've pushed back. They think that the U.S. Is unfairly trying to stop their rise in the technology area. They want to be able to build these capabilities within the country. They're investing billions and billions of dollars into companies, into venture capital funds to be able to invest in semiconductors in particular, because that's sort of the foundation of the tech industry, but also areas like artificial intelligence and robotics, autonomous driving, et cetera. Also,
of course, the animosity, shall we call it that, between China and US on the level has also spread into the world of social media. And time again, we've heard perhaps the likes of Meta say, you know, the reason we need to keep on building and scaling is because otherwise China will come in, and they mean TikTok. TikTok's already got a real foothold in the US, and there might be reasons for concern. Can you elaborate a little bit on what might be so-called propaganda developments in that space?
Yeah, TikTok, of course, is one of the apps that was developed by this Chinese company, ByteDance. They have a whole bunch of them, but TikTok is the one that's really taken off in the US. It's very popular with teenagers in particular. And it first came under scrutiny under the Trump administration, which planned on banning the app for a while, and they were going to force the company ByteDance to sell off ownership of TikTok. It's become very popular, and there are concerns about national security. So the latest story that you're referring to is that we found information that the Chinese government had gone to TikTok and had tried to set up a channel where they could put out their point of view, their kind of nationalistic point of view, and advocate for the Chinese point of view in the world without disclosing where it was actually coming from. TikTok, in this case, pushed back and said that they would not comply with those regulations. They don't want to be viewed as a propaganda arm of the Chinese government.
They certainly don't, particularly when they do want to keep on expanding in the Western world. And to that point, Peter, there has been some interesting reporting from Bloomberg just about their foothold in Gen Z and the way in which Gen Z use TikTok.
Right. Well, TikTok is just exploding in popularity, and it has been for quite a few years. What's really changing now are a couple of things. One, TikTok is beginning to cash in on that popularity. They figured out how to use advertising to be able to bring in revenues, and we've talked about how their revenues are surging. They're likely to go to about $12 billion this year. As part of that, they're moving beyond their old kind of platform. They used to be viewed as mostly entertainment. They were short videos that people would watch. If you had to search for something, you would typically go to Google, of course. But now what you're seeing is that TikTok is actually being used to find things in the way that you used to look on search, especially with the younger consumers.
And getting their news as well. Bloomberg's
Right.
executive editor for Asia Technology, Peter Elstrom, keeping it on linear TV for us for the time being. But meanwhile, coming up, shares of Intel plunged today, and the CEO told Bloomberg that its stock deserves to be down right now. Mea culpa moment. We'll share more in that interview. This is Bloomberg. Chipmaker Intel has, well, slashed its sales and profit forecasts for the rest of the year. We heard that after the bell yesterday. And of course, CEO Pat Gelsinger conceded that Intel needs more time to make its products competitive. At the same time, well, he assured investors, look, that the current quarter will be the low point. Here's some of his conversation with our colleagues Anna Edwards and Alex Steele.
We expect 22 and 23 to be challenging. And we had great wins yesterday that we announced with Amazon, long-term multi-generation partnership with Meta. And, these are areas where we are going to go fight every customer, every socket, every workload. But we expect that 22 and 23 are challenging years until we get the products that are just unquestionably the best in the industry.
Macro headwinds, are they something that you are factoring into your expectations for the business, the extent to which you want to invest in the business?
The enterprise market continues to be strong. It's really focused. The weakness in the consumer market has been where we've seen it quite acutely in this period of time. But like semiconductors, it's a cyclic industry, and it always has been. And we're going to embrace this and make the company stronger, better. And some austerity helps to drive my transformation agenda more rapidly into the company as well. And thus, we feel like this is the bottom. That's what we clearly communicated in the earnings call. And we're off to the races to do better for ourselves and for our shareholders into the future.
You guys also talked about your new guidance for full-year gross margins coming in around 49%. A lot of analysts were really skeptical of that number after the call, that it's just too hopeful, considering all the pricing pressures that everyone's under on chips and increased process nodes costs, et cetera. What's the probability you're going to have to revise that lower?
Well, we clearly set out a framework of our financials that we are confident in that we can meet and beat. So our confidence is high. We also had some one-time things in the quarter like inventory reserves that will naturally reverse. Some of this was the, dramatic swings that we saw in the quarter. We weren't able to adjust our fixed costs that quickly, so we'll have more time to do that in the second half of the year. And with new products ramping, they're very negative, and as they start to ramp, we get better margin structure. So overall, we're confident in the guide that we gave for the year, and we have a natural strength of shipping more products in the second half of the year, normal yearly cyclicality.
Intel stock is down 33% this year. It's down 10% today. The market is just not buying what you're selling. What is everyone getting so wrong then?
I think we deserve to be down today. And with the earnings that we report, the guidance that we gave, it's a bit of a reset. And I think we've disappointed ourselves and our shareholders in that respect. At the same time, we've laid out a multi-year path to the future, and we're confident that that will, be realized. And we're getting more and more proof points along the way, such as our technology and process. That area is one that everybody has said is most critical. And Intel 7, Intel 4 got, very positive reviews. We're ahead of schedule on Intel 3, 20A, and 18A. And if I have leadership process and capacity, Intel's going to do fine for the future. We had neither. We're getting back both of those as we go forward. So we're working on it, but clearly this is a journey.
It is a journey. What difference will the CHIPS Act make to your journey?
The CHIPS Act is a seminal act this may be the most significant industrial policy legislation that's been put in place since World War II in the U.S. This is huge. Clearly, we said, we are expecting and to be a beneficiary of that, both in the near term, right, with the manufacturing offsets, and we have an aggressive capital build for that. The tax benefits will be helpful, but long term, the research portions of the bill are huge for long-term leadership as well. This is good for the industry, it's good for the United States, and Intel will be a beneficiary thereof, and I'm proud to have played a part in getting it across the line.
Intel CEO there, Pat Gelsinger on Bloomberg TV. Meanwhile, coming up, it is a date. A judge decides when Musk Twitter trial, when it's going to begin. Boy, still until October. Meanwhile, plus Meta and its peers are in the FTC's crosshairs as the government looks to slow down big tech M&A. We'll discuss. This is Bloomberg. So Twitter's lawsuit against billionaire Elon Musk over the cancelled $44 billion buyout of the social media platform set for a 5-day trial starting October the 17th in Delaware. Twitter's lawyers say they'll need only 4 days to prove Musk is misusing questions about spam and robot accounts as an excuse to walk away from the deal. Musk is arguing Twitter's handover of the so-called bots material hasn't been robust and the company's mishandling of that data provides a legitimate basis for backing out. Kurt Wagner joins us now to, well, explain why we have to wait all the way until October. But meanwhile, we get the drip feed of news, and we understand Musk has indeed filed counterclaims in the lawsuit over the buyout, but we're not going to be able to read them.
Yeah, exactly. I believe they're not public right now, so we can speculate as to what they might say. My guess is he's going to say, hey, listen, the bot thing is a real issue, and, see you in October. We can talk about it. But as you mentioned, this trial, we knew it was going to be in October. The two sides were kind of arguing a little bit over when it was going to be. Twitter had wanted it to actually be a week earlier than what it's scheduled, which is right now for Monday, October the 17th. So clearly they were able to, find a date that works for everybody, and I guess we'll see you there.
5 days, 4 days, all of it. I mean, Delaware, a court in Delaware is known for speed, right? But is this particularly fast, or give it a context here?
Yeah, it does. It feels a little fast to me, but at the same time, I mean, so much. This feels like a sort of simple case in the sense that both sides have already signed this merger agreement, right? We know the issues at hand, right? It's this bot issue. And so to me, it's like everything is already kind of laid out. And so as you pointed out, I think Twitter thought that they could do this in even 4 days. The trial's supposed to be 5. So clearly they think they can make their case quite quickly. And, we'll find out. But it sounds like it's going to be that 5-day week and hopefully have a verdict or some kind of solution by the end of the week, October the 21st.
For lawyers, 3 months is pretty short. For our short-term media mindset, it feels like an eternity. What are you expecting next? What do we look out for?
Yeah, well, behind the scenes, we're going to see both sides, doing all the things that you do for a trial, right? They're going to be requesting documentation and providing documentation to one another. They're going to be setting up witnesses, all of that stuff. I think in the meantime, there is supposed to be a vote from Twitter shareholders in September to kind of formulate the deal. Create the deal and make sure everything is good to go.
Formulate's
and that's going to be in September, and that's a way for them to try to show that they're moving forward with this whole thing and they're not, letting this get derailed.
It's a Friday. I don't know what my name is anymore, let alone how I say formalize or formulate. Kurt Wagner, thank you so much for being in the studio. We really appreciate it.
Yeah.
Stay well. Meanwhile, Federal Trade Commissioner Chair, that is Lina Khan, is sending a pretty strong warning sign to Silicon Valley by trying to block Meta's pursuit of a VR fitness app within. Khan overruled, actually, her staff's recommendations to allow Meta to buy the company as part of its metaverse expansion. Now, that aggressive approach for a pretty minor deal, seemingly, suggests that the FTC is going to play hardball with big tech M&A, as if we hadn't guessed that already. Bloomberg's Max Chafkin is here to tell us, first and foremost, Lina Khan overruling sort of advice by her own economists, their own lawyers within the FTC to say, no, look, we're going to go ahead and pursue this case. How big a deal is that?
Well, it's a big deal in the sense that what we're finally seeing is Lina Khan sort of following through on something that I guess a lot of political observers have been expecting, and that hadn't happened kind of in the early days of the Biden administration because you had this 2-2 deadlock on the FTC. Now we have another Democratic commissioner, so it's 3-2. So all of a sudden, cases like this can proceed. And the rationale here is basically that Facebook already has dominance of VR, which, although it's a nascent platform, is potentially an important platform. And in acquiring this smaller company, as you said, for not a huge amount of money, that allows it to extend its dominance. Now, this is super controversial, kind of in Silicon Valley, because what Facebook is doing is something that not only has it been doing for basically the last decade, but the entire industry has been doing, right? It's a totally part of the playbook that these big tech giants look to get into new platforms like VR by doing purchasing. And the FTC is saying, hey, wait a minute, maybe this is not going to work anymore.
I mean, according to the House, what is it? Meta has made 100 or so purchases of smaller companies. And of course, the FTC itself is already pursuing a monopolization case when it comes to social media. They're now saying that, look, you're monopolizing the world of virtual reality. But is Meta the main company that's going to be at risk here? Or is this more precedent setting for an Alphabet or an Apple?
Well, I think it's certainly something that Meta in particular has, employed extensively. We're seeing separately. What makes this this lawsuit so interesting is that separately, of course, Mark Zuckerberg is running into real problems with growth, problems with, privacy, the Apple stuff. And we're seeing, earnings that are disappointing. And the way that Facebook has Meta has gotten around this, in the past is by buying companies. When there was the shift to mobile, some of that innovation happened inside of the company then called Facebook. But what really propelled Meta, Facebook to dominance was the acquisition of Instagram. Of course, that was not a huge acquisition, not that much bigger than the one we're talking about here. And then the acquisition of WhatsApp. And that is, given it this huge dominance of social media. If Facebook had its druthers, if Mark Zuckerberg had his druthers right now, he'd probably be trying to buy TikTok. Of course, that's kind of out of the question right now because, the FCC is never going to go for that. They won't even let him buy this tiny VR company.
And of course, Lina Khan, we knew that her writings in academia was about Amazon and about the world of consolidation. It's sort of taken a bit of time, hasn't it, to finally get this bite rather than the bark?
Yeah, and as I said, she has a very narrow window, and Bloomberg has written about this over the past couple of months. But because you had a 2-2 deadlock, she really wasn't able to do anything. You get this new Democratic commissioner, and that gives her a 3-2 edge. It allows a case like this to proceed. But the issue is that once we hit the midterms, if Republicans take control of Congress or take control of one of the houses of Congress, as we expect, then you're going to see pushback, congressional pushback, probably from Republicans, and that's going to limit her ability to get things done. So there's this very narrow window politically, and she is, of course, trying to pursue it. So in that sense, it's not that surprising.
Yeah, of course, the two Republicans voting against this action on the FTC. Max, always great to have your expertise with us. Thank you. Bloomberg's Max Chafkin. Have a great weekend. Meanwhile, coming up, as the world slowly but surely still moves towards Web3, as we like to call it, we'll talk about the need to, well, maybe own your own digital identity in domain names. Unstoppable Domains. It's just raised some funding. It's the new unicorn in the Web3 space. Tune in for the interview with the CEO. This is Bloomberg. Time now for our crypto report. And here's some optimism to wrap up the week. Bitcoin, Ether, world's two largest digital tokens, headed towards their best month since 2021. This amid a revival of risk appetite in global markets. Let's bring in our crypto contributor, Shonali Basak, who, well, we know risk assets were well played for the month of July.
Absolutely. So let's talk about what that means for Bitcoin, because on a 7-day basis, Caroline, you're seeing it up more than 5%. It is starting to waver a little bit under $24,000, but it does have a nice little rally. And you look at that rally right here in the middle of the week, right after the Federal Reserve raised interest rates. That was supposed to be something that may have muted risk appetite, but it certainly did not in the case of Bitcoin this week. And if you take a look at Bitcoin over the full year, where does that leave us in terms of climbing back up towards where we were before? We have a long way to go, because we were closer to 68,000 when we looked at it at the high over the 1-year period. We're not even really where we were for the average for the full year, where the full year average was a little over 41,000. So that 24,000 mark is an exciting little jump you have here. It still is less than half of where you were, almost a third of where you were at the peak in the last year. Let's look at Ethereum as well here, because actually you had an even bigger jump this week in Ethereum than you had in Bitcoin. Of course, it is a smaller asset. It is a smaller asset by its market value. 13.5% jump there. So there's a lot of excitement here about Ethereum, about the merge that is anticipated in the coming months. So the question here is this a valuation play when you look at Ethereum versus Bitcoin? Is it a fundamental play? Are people more excited about Ethereum's future? Let's look at over the year, though. You do have that 25% decline over the year in Ethereum as well. Still a long way to climb back.
Context is everything. Shonali, thank you. And you're going to be sticking with us, because we're going to turn our attention to our next topic, digital identities. Now, Unstoppable Domains, talking of valuations, a Web3 digital identity startup, just become the latest crypto startup to become a unicorn. Indeed, the crypto winter not actually affecting everyone in the same way. I'm pleased to say that Matthew Gold is with us, CEO, founder. Congratulations on the fundraise, I understand, being led by some key VCs in the space. Talk to us about what Unstoppable Domains is trying to do. Am I going to be buying caroline.hide.ether or whatever it is in the future, and what reason would I need it?
Yeah, so we're on a mission to provide user-owned identity to all 3 billion internet users on the planet. And we do that by creating NFTs, and in this case, NFT domains like caroline.nft. And we believe you're going to use that not only for sending and receiving crypto payments. So if you believe in crypto long-term, everyone on the planet is going to be sending crypto to each other. So you're definitely going to want a domain name to make that simpler. But we also think you're going to use that to log into all your different apps. And people are already doing that right now for Web3 applications. And we think it's going to spread across to the rest of the internet as well.
The rest of the internet, talk to us about how Unstoppable Domains is kind of creating the next version of the internet alongside you and your rivals. What was the real pitch you had to investors to really buy into the future here at a time where we're facing so much pressure on the market overall?
Yeah, well, people spend 50% or more of their time online now, just staring at a screen. And less than 1% of the things that you own are likely digital assets. And we think that over the coming decades, that's going to change. So you can see a lot of value being created in crypto, trillions of dollars in value here. We think that's only going to increase. And you see Mark Zuckerberg spending $10 billion to build the metaverse and VR. And that just says to us that there's a huge bull market in digital assets over the next decade. And we think that one of the first things you're going to want to own online is going to be your name and your reputation. And that's really the push behind digital identity.
Uh-oh, Matthew, I'm already thinking how hard it was to get my Twitter name or my website name or things like that. Are there going to be countless? I mean, are we going to have like Caroline Hyde version 1, 2, 3? Like, explain to me exactly how it's going to look, how it's going to feel, the domains.
Yeah, so you actually had a really good example there. How much do you think, Elon Musk's Twitter handle is worth to him, right? And it's probably worth $1 million. And the thing is, he doesn't own that name on Twitter. And he could get kicked off of Twitter and he could lose it, right? And this is kind of the whole promise of Web3 and crypto in general, is that you should be owning these digital assets. And so instead of having like one name on Twitter and a different name on Instagram and a different one on Reddit, you could have a single name that you own and control inside your crypto wallet. And then you can use that to sign into these different social applications. And then you would have a consistent reputation.
But how expensive would it be? Like, what if someone just went out there and bought all the celebrity ones up?
Yeah. So the domain names are anywhere from $5 to thousands of dollars. It's kind of like the traditional domain name industry, with one major difference is there's no renewal fees for NFT domains because they are blockchain assets. And through our partners, you can actually get domain names for free. So a lot of wallet apps now are working with us to make sure that everyone who downloads a digital crypto wallet also gets a domain name so that they have an easy endpoint to deposit money into their application. So there's not going to be a barrier to entry here if someone wants to get on. But then on the high end, we are seeing sales for these domain names in the hundreds of thousands of dollars for some of the more premium ones.
Help us understand this. One of your investors is online talking about how you're kind of what Coinbase is to crypto, you are to Web3. What does that really mean? And how does that kind of put you at the center of an industry in that kind of a way?
Yeah, so the very first simple use case is sending cryptocurrency. And if you have like 20 or 30 different cryptocurrency addresses, you're not going to be able to remember all of them. And they're really long computer hexadecimal addresses. So that's kind of like IP addresses on the internet in the early 90s. And everyone replaced those with domain names like .com. And this is like that except for individuals. So for .com domain names where you have maybe 50 million businesses and 300 million registered domains, for this, we actually think it's going to be every single user on the internet. So that's 3 billion people with an NFT domain to make it easier for people to find information about them, verify information about them, and send them money. So if you ask me, like, what am I going to be using this for? We think it's going to help you have portable reputation on the internet. And so, we have two major problems on the internet. One right now is that you actually can't own anything. And then the other one is all these problems around fraud, spam, bots, et cetera, that we actually just talked about with Elon Musk in the prior segment. And if you had portable reputation, you could actually help solve that problem. So I'll give you for instance, my dad actually bought tickets on eBay and it happened to be from a scammer. And the thing is that scammer can actually just go and then start selling fake tickets or whatever on a different website like Amazon Marketplace. And because there's not a consistent reputation across applications online, these applications can't check and see if that person is potentially doing fraud. But if you had a consistent reputation so that you were Caroline.nft on one platform and then you're Caroline.nft over here and you're Caroline.nft on Twitter, then you have a consistent reputation. And we think that actually makes the internet safer.
Very briefly, Matthew, and I understand it's a hard one to have to tackle, but this is a time where valuations have crumbled. You've managed to get an above $1 billion and a 65 million amount. Did you have to downgrade a little bit when you first started having the conversations?
So we've seen cooling across the whole market. So Unstoppable Domains is no exception to that. We're just fortunate enough to be working with some investors who've been in the space for a long time. Pantera is our lead for this. They've been investing in crypto for 10 plus years. So I'd actually say to founders out there looking to raise money, if you're in it for the long run, then I think you'll be fine going out and funding right now. It is significantly harder than it was in 2021, but that's okay. I mean, if you're here to really create utility for users instead of speculation, you'll still find a business model that works and you'll still be able to figure it out.
Well said. Matthew Gold, thank you so much, CEO and founder of Unstoppable Domains. And Shonali Basak, as always, thank you so much. Meanwhile, coming up, Hollywood's got a pretty complicated relationship with anti-abortion states. And we're going to talk about what it's doing in terms of business in those states and whether or not pushing back or not. This is Bloomberg. We want to take a moment to look at the relationship between Hollywood and anti-abortion states now. We often consider perhaps media companies, movie stars, to be relatively outspoken about the overturning of Roe versus Wade, even some attending protests sometimes. But the Hollywood machine is sort of not taking sides. It's spending billions in film and TV production in states seeking to restrict or outlaw abortion. I want to talk about perhaps some of the tension there with Bloomberg's media and entertainment editor, Kelly Gilbom, of course, who's here, who's just got over COVID. So we thank you so much for doing it with us. And Kelly, what I'm really interested in is, look, we're not going to take sides either because we know this is a nation divided. But talk to us about how there is a tension perhaps between employees that work at certain media companies and the decision-making process that media is in terms of spending money and making movies and TV productions in states that perhaps some employees might feel don't reflect some of the way they want their U.S. to reflect.
Really hard position for these big media companies to be in today. You know, Hollywood, I think people there kind of see the business as both being part of culture and leading culture. So when there is a big social issue they feel strongly about, they like to be at the forefront of that. But at the same time, for each project that you see, each television show, each movie, these take years and years of planning. They're incredibly expensive, and every single line item on the budget that can be removed is going to be good for the overall production. And sometimes the financials mean the difference between something getting made and not getting made. So states like Georgia, for example, that has tried to put in more restrictive abortion laws have been really good at being the cheaper option for some of these companies. So they've got to balance getting their projects made, but at the same time, they do have a lot of employees that are pretty outspoken. And not only that, but they've got business partners like actors and directors that are outspoken too about their values. So they're trying to both run the companies and try to keep these employees happy and not make this a talent retention issue at the same time.
Interesting, the talent retention element of it, Kelly, as well. I mean, are there new states, other states that are trying to woo the making of movies and TV in that place because they say, look, we're not looking to change anything up in terms of ability to access healthcare?
You know, I did a lot of reporting on this, and I was a little surprised that the other states that are not seeking to restrict abortion rights, they're not selling themselves quite as much. I covered talked about one interesting case in a story I wrote about a film called Eric LaRue. This is a film directed by Michael Shannon. It actually was a project that was set to start filming in Arkansas. That's a state that has some of the most severe abortion restrictions. And the filmmakers actually decided to move it to North Carolina, a more free state. But the film officials that I spoke to in North Carolina weren't out there trying to say, hey, come here. They were just saying, you know, that's great. But honestly, we heard about it from you in the press. You know, they're not trying to make that pitch that hard. But, you know, it could be something that affects the business long term if people are pressuring the executives of this company, if they're finding, you know, actors that are going to attract people at the box office don't want to film in those states. It could be a long-term benefit for other states or other countries that both have financial incentives for filmmakers and are more free on the abortion issue.
It's a fascinating read. Thank you so much for spending some time just outlining the depth of your reporting that went into it all. Kelly Gilblum, of course. She is a media and entertainment editor here with Bloomberg. And of course, that now does it from this edition of Bloomberg Technology. We have a special episode coming up Monday. We're going to focus on antitrust legislation, scrutiny of big tech in particular. We've just been discussing it, of course, with our own Max Chafkin about the FTC, the focus on Meta, so you do not want to miss that conversation. Meanwhile, of course, catch the podcast. You can find it on the terminal, as well as online on Apple, Spotify, iHeart. You don't want to miss that one either. Have a wonderful weekend, everyone. This is Bloomberg.